Welcome to this week's edition of Flashback Friday, your opportunity to get some good review by listening to episodes from the past that Jason has handpicked to help you today in the present and propel you into the future. Enjoy.
This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine, self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to the Creating Wealth Show. This is your host, Jason Hartman, and this is episode number 274. Thanks so much for joining me today. We're going to talk about some interesting stuff. We've got a great guest coming up after the intro portion of the show that I'm doing with one of our investment counselors, Steve. How are you, Steve?
Not too bad. How are you?
Good, good. Hey, not too bad. That's not optimistic enough. You know what I want to say? Here, hey, everybody listening, and Steve, you got to try this out. Sometimes when people ask me, how are you or how you doing, I say this, and it really freaks people out. If I was doing any better, I'd owe the world a rebate. Try that one, okay?
I will do that today. I'll report back on how it goes.
Okay, let's do a test. Steve, how you doing?
If I was doing any better, I'd owe the world a huge rebate.
Awesome. Fantastic. Or at least a TARP bailout, right?
Oh, wow. Yeah.
Hey, I wanted to have you on today. You know, you're one of our investment counselors, and we haven't had you on the show before. I've known you for, I don't know, about a year now, maybe a little over a year slightly. And I'm glad that you're working with us, but we have not exposed you to the podcast yet. So thanks for joining us here today and helping me with the intro portion of the show. So it doesn't have to be a monologue, right?
Yeah, my pleasure. Yeah.
Well, hey, we're going to talk about a few interesting things before we get to our guest today. You know, the first one, Steve, I wanted to chat with you about is commandment number 3, thou shalt maintain control. Probably one of the most important of my 10 commandments of successful investing. And there's just story after story after story of scandals in the financial world. I mean, I'm sure it just blows your mind as much as it does mine and all the listeners. And, you know, we've got this new story about Knight Capital. This is a firm that's on the brink of disaster now after millions of accidental trades. Wow. What do you think?
Well, you know, we're looking at the commandments here. Obviously, we want to maintain control of our investment because in one of the subheadings of that commandment, you might be investing with an idiot.
Yeah,
and
yeah.
I think that's what happened here.
That's a very good point. A lot of times I really hedge, I really sort of focus on you might be investing with a crook. There are 3 things. So that's very good that you brought that up. The first one, you might be investing with a crook. The second, you might be investing with an idiot. And the third, assuming they're honest, assuming they're competent, they take a huge management fee off the top. But here, this is just an example of investing with an idiot, right?
Oh, yeah. Yeah. How'd you like to be manning the tech support desk that day? 45 minutes and $440 million in trades in that time period because this new software that they implemented apparently just went haywire.
Unbelievable.
Yeah, it's crazy. It's crazy. I don't think I can put any kind of money into something like that where you can have some kind of a bad horror movie plot take over and the machines just run wild and burn through all the money in 45 minutes.
Well, you know, there are many science fiction movies about that, including the most famous 2001 that was a great movie produced back in the 60s, and how computers might take over the world and really mess things up. And, you know, this is an example of it, isn't it? $440 million, almost $500 million as a, quote, accident, unquote. I mean,
that's right. That's
shocking,
right.
Huh?
Yeah, 4 times their annual net earnings in 45 minutes.
Unbelievable. So do you think the investors are going to lose money, or does it still have to be determined?
Oh, geez, who knows? Who knows? I mean, it's a big chunk of money, but I think they got to somebody who offered to buy them. They're getting some capital to, hopefully erase this mistake, but they got a big hole to dig out of. The too big to fail criteria is very subjective, and there's only a couple of people who have that instruction manual, and I'm not one of them.
Yeah, and that whole too big to fail and depending on government bailouts thing, especially if Romney wins in November, I think you're going to see that go largely by the wayside because there's just so much anger and opposition against these bailouts that it'll be interesting to see if it actually happens. If Obama wins, I think it'd be more likely we'd see more of that in the future if it happens. So print fake money, bail out the rich, bail out the elites, so that they basically have corporatized socialism. So all of their gains and wins, well, that's part of capitalism. All of their losses are socialized and on the burden of the taxpayer, but not really even the taxpayer. And that's the interesting thing. We always talk about it's a taxpayer bailout. Not really, because when you really think about it, Steve, it's really a bailout of anybody who has any assets denominated in dollars, because the value of those dollars will decline as they print fake fiat money to bail these criminals and idiots out over and over again. Just unbelievable.
Yeah, it is. It is. And it'll require more and more money for every additional bailout. It's going to continue to separate the poor and the middle class from the elite. It's going to be horrible. The inflation that's going to result from that is just going to absolutely wipe out anybody who hasn't positioned themselves correctly now.
Yeah, and the basic positioning concept, just as a reminder to all our listeners, is denominate your assets in things. This is the Jason Hartman philosophy, basically, right here. You're going to hear it in like a sentence. Denominate your assets in things that are of universal need, like housing, for example, and denominate your liabilities in depreciating dollars where the debt will be inflated away. So have debt, long-term fixed-rate debt, that buys you those things like packaged commodities, housing, right?
That's right. That's right.
Good stuff. Well, let's talk about a really negative article. The website Zero Hedge, a lot of my friends like this website. It's sort of pretty wonky. I guess nobody knows who writes this. This article was submitted by, get this name, Tyler Durden. Now, do you know who that is, everybody?
I don't know who that is. Educate me.
Let me tell you something. One of the best written movies, I'll just tell you a little story about this. I saw the preview for a movie called Fight Club many years ago. And I was in Chicago, and I was waiting for this girl to fly in who was going to come hang out with me. She was flying up from Dallas, and she missed her plane, and she was late.
Welcome to this week's edition of Flashback Friday, your opportunity to get some good review by listening to episodes from the past that Jason has handpicked to help you today in the present and propel you into the future. Enjoy.
So I was wandering around Michigan Avenue in Chicago, and I didn't have anything to do. So I wandered by a movie theater, and the only movie that was playing at the time that made sense for me to just walk in and see a movie was, guess what? Fight Club. Okay. And from the previews, I didn't want to see this movie. It looked barbaric, like a bunch of guys who fight and beat each other to a pulp. I mean, terrible. But let me tell you, that movie is so well written. It was very, very clever. Really one of the great movies in terms of the writing quality. I really appreciate writing quality and dialogue in movies and the concept like that. And Tyler Durden, as I recall, now my memory's foggy here, was the guy who was trying to wipe out all the debt by basically bombing all these corporate offices. And at the end of the movie, you see all these skyscrapers just crumble away. And the whole concept was to wipe out the debt that the corporatocracy had gotten all the consumers to charge up, so they became basically slaves to the system. So this is obviously a fake name, right? On Zero Hedge, you never know who writes these articles here. It's all like an anonymous blog site. But
it does have Brad Pitt's picture there at the side of the article.
There you go. Yeah, exactly. So anyway, this was kind of an interesting article, and I want to kind of dissect it a little bit. Tell us about it.
Well, essentially, the article, it's very doom and gloom oriented about the future of the housing market. It's forecasting that there are essentially 14 million homes in the so-called shadow inventory. And everybody has their own definition for what shadow inventory is. But, a really broad definition of that for our purposes here are homes that are at high risk of being foreclosed and, being distressed for sale homes on the market. And he thinks that, the home builder projections over the long term, where they're at right now, are still way, way, way too low, despite all the positive news about home builder sentiment and housing starts and building permits that's come out in the last few days.
Well, and let me tell you, just want to mention on home builder sentiment, it is amazing how bullish the home builders are and how quickly that has changed. I mean, it's like I read article after article after article about how the home builder sentiment is the best it's been in 5 years, and builders are starting to build again. And that is amazing. I mean, imagine if you're one of our clients listening and you had the foresight and the vision and the courage, really, because it took some courage, a few years ago, to buy into some of these properties when you could get them for $35 or $40 per square foot. And now builders are building, and in most markets, the stuff they're building is about $100 or even a little more per square foot. In markets like California or something like that, it's way more. But you just built your profit in. There it is. You got it. Okay, congratulations. You won the game.
That's right. If they were feeling any better, the world would owe them a rebate right
There
now.
you go. There you go. Now, one of the things, though, that causes builders to build and makes builders feel optimistic is when the money starts flowing in, right? And so this shows us that the money is moving off the sidelines, and that is causing builders to feel the wealth effect, but also people are buying the houses. I mean, inventory is dwindling, but here you've got this article that is very negative, right?
Right, it is. And one of the main things that it brings up that I think is very good for what we're doing here when it comes to purchasing income property with long-term fixed rate debt, it's saying that consumers don't want to buy these houses because they're uncertain about the economy. They don't want to make any long-term decisions, and purchasing a home is a long-term decision. So even if that were the case, obviously you want to own a bunch of rentals, right?
Most definitely, because that means more renters, right?
That is exactly right.
And here's the other thing. When they say something like, people are afraid to take risk, they're afraid to make decisions like long-term commitments, like buying a house or an investment property. And the reality is, though, in most cases, Steve, and you know this as well as I do, the person taking the risk is the bank. It's not the buyer. I mean, the buyer, if it's an investor and they can get financing, they're taking 20% of the risk, and the bank is taking 80% of the risk. If it's a homeowner who's buying on a conventional mortgage, they might be taking 5% of the risk, or 0% in some cases, depending on the type of financing they get. And the bank is taking 95 to 100% of the risk. So what is the risk? Committing to a 30-year mortgage? Well, we've all seen what happens. I mean, this is counterintuitive. We've all seen what happens. If people can't pay the mortgage, what do? They just walk away. Show me where the big consequences are. You see all these strategic defaulters out there, and it sounds crazy. It sounds counterintuitive. It sounds irresponsible. If you're a first-time listener listening to me say this, you think, this he's out of his mind. Well, not really. Go back and listen to some of the old episodes where we interview some of these people. We interview some of the experts on this, and you'll see where, in some cases, it's almost a no-risk equation, isn't it?
I think so. And as long as we follow that commandment that the deal must make sense today, the economy and the housing market can do what it will in the future. But if the deal made sense when you purchased it, and you've got that long-term fixed rate debt, like you said, there's really no risk. I mean, tenants are paying all that mortgage for you, and it's so cheap right now. I mean, most of the properties that we do are $100,000 and under, and the mortgage payments are very, very small on those things, and they're fixed. They're fixed for the next 30 years. I just don't see the doom and gloom that this article presents. I don't see it.
Yeah, I don't see it either. I'd love to see one of these guys, whenever I see this kind of stuff, they never really take into account population. Now, granted, the population is increasing pretty dramatically, both through birth rate and immigration. Now, immigration has declined since the economy hit the skids, for sure, which almost points out how Mexico is exporting their poverty to the U.S. Mexico needs to solve their own problems, and the corrupt government there. What they really need is a revolution in that country so that the people can start to have rights, because it is just unbelievable how their government is just constantly abusing the people there. And it is so sad, really. But Mexico is just taking its problems and exporting them to the U.S. But at the same time, the U.S. is really an accomplice in Mexico doing this, because what they're doing is they're importing deflation. And this is why inflation isn't much worse, because if you can import cheap labor from Mexico and import cheap goods from China, the only thing you don't have in America is jobs.
That's right. That's right.
You get to say the inflation rate is much lower, because it is. But it's just interesting to see how this will turn out. But these guys never really talk about the population. They talk about the shadow inventory, and I agree there is a lot of shadow inventory there. But the other thing they don't talk about, and Steve, we've had this discussion before. Remember all of those articles we saw a few years ago about the timeline for adjustable rate mortgages adjusting? Okay, Do you remember those?
I do.
I mean,
yeah.
The doom and gloomers love this stuff. Whether you were reading The Daily Reckoning, any of Bill Bonner's work, or Addison Wiggin, who we had on the show. I think Addison Wiggin was like episode number 111 or back there somewhere in that range. And all the Agora press, and we've had a lot of those Agora guests on the show. All of the Agora press and, a lot of the major media press was saying, oh my gosh, there's going to be this tsunami of foreclosures as adjustable rate mortgages adjust. And they could tell based on the origination times of these mortgages when they were going to adjust. Very true. But you know what they completely left out of that equation? They were looking at origination data. They had no idea how many millions of these properties were sold, how many of them were already foreclosed on and being resold, how many did loan modifications or workouts, and how many where the people could actually absorb the payment and make the payment. They didn't tell you any of that. And one of these big waves, by the way, was last year. I think it was May or June of 2011. That was like a huge spike whenever you'd look at these graphs of these adjustable rate mortgages. Oh, the world is going to come to an end. These, when these mortgages adjust, there's going to be 10 million new foreclosures. I'm just making that number up, but a whole bunch of them. And everything's going to go to hell in a handbasket. The reality was, a lot of those problems had been solved already before those loans even adjusted. They were solved preemptively, either by the person selling their home, refinancing it, short selling it, getting foreclosed on already, doing a workout or a loan mod. I mean, it just doesn't tell you that. It's like it gives you half the picture.
Yeah, you're just assuming that because it's an adjustable rate mortgage, it ends up in a foreclosure. That's not the case. There's plenty of people that took those out that actually could afford them, that could get the workouts, that already sold the house. So that storm wasn't nearly as big as those people predicted it to be. And they defined that as shadow inventory. And nobody really has effectively defined what that is. This Zero Hedge article was talking about 14 million homes in the shadow. I've read recent reports from Morgan Stanley that say it's more like 6. Then I hear on CNBC that it's 1,
Well, we've
if
gone
the deal
from,
makes sense today,
yeah,
you're good.
Right. Yeah, I agree. We've gone from, just in this talk, we've gone from 1 million, 6 million to 13.5 million. It's all over the board. That's the whole point. Yeah, no question about it. And then you look at stuff like this. Here's an article. This is an Associated Press article, and it's dated August 8th. Okay, so it's fairly recent here. And it says, U.S. late payments on mortgages hit a 3-year low in the second quarter. It says, Los Angeles, U.S. homeowners are getting better about keeping up with their mortgages, driving the percentage of borrowers who have fallen behind to a 3-year low, according to a new report. So when you've got rates this low, there are so many escape hatches for people that the shadow inventory thing, I think, it's overplayed. It really is overplayed. Now, of course, and we'd be remiss if we didn't talk about this, Steve, but remember the famous quote, all real estate is local. So the question is, where? In a country as large and diverse as the United States, there are 400 distinct major markets here. So I'd say that the places where you have the most adjustable rate mortgages are markets that we'd avoid, like the Socialist Republic of California, where you have high land values, where you have properties that do not make sense the day you buy them. Yet, I do have to say, prices are actually rising in many California cities right now as we speak, but I still wouldn't touch it because the cash flow doesn't make sense, and the risk is still very high. But places like New York City that are expensive, any expensive markets, that's where you see more of the adjustable rate mortgages. You see a lot less of this stuff in the Midwest, in the South, where people are more conservative, where they can actually afford their homes more often than not, and it's just kind of a different world. So that's another thing to know.
Yeah, it definitely is. I talked to a client from New Jersey the other day and told him what the investment price of one of the properties are that we're doing right now. And we had to talk for a few minutes about how that was the whole price. It wasn't the down payment.
Yeah, it's like sticker shock in reverse, right?
It is, yeah. It's ridiculous.
We should make up a new phrase for that, Steve. Let's call it sticker joy.
Sticker joy.
Instead of sticker shock. Yeah, absolutely. And then there's a whole nother component that we didn't mention yet, and that brings me to another article about, this one's entitled, this is a Newser article entitled Foreigners Gobbling Up American Homes. And this says that non-natives, non-Americans, are taking 8.9% of all U.S. home sales. I mean, that's an amazing thing, that almost 10% of the American market just right now is driven by foreigners. The article starts off, it says, the Canadians are coming. Okay, ... for our real estate. A weakened dollar coupled with a buyer's market is prompting foreigners to snatch up expensive homes here in the U.S. Of the $928 billion spent on U.S. real estate in the year ending March, $82.5 billion came from foreigners. Our neighbors to the north accounted for the most, with 24% of all foreign home sales just going to Canadians, followed by Chinese at 11%, according to Forbes magazine. And while the Russians might get most of the media attention for the millions they drop on swanky apartments, hey, that's my favorite word, isn't it? Swanky.
It is. I didn't know you were Russian.
No, but I'm not. But I like the word. It's good. So the Russians are dropping a lot of money on swanky apartments, and I'm quoting that from the article. Buyers hail from all corners of the globe, including Argentina, South Korea, Armenia, Brazil, Peru, and Malaysia. So isn't that amazing, Steve? I mean,
that is amazing. And I would say two things to that. Number one, congratulations to the foreigners, the Canadians, Australians, Israelis, everybody that sees the opportunity in this market. They see it for a reason, and they're willing to put their capital into this market. Number two, Americans, your country's on sale, and everybody else knows it. Yeah. It's time to buy some income property. And I talk to foreign investors every single day that are searching for good deals here in the U.S. because they know that this is such an opportune time. Much of the world, especially Europe, with all the turmoil that it's in, the article mentions this, they need somewhere safe to put their money. They feel like putting it in the U.S. housing market is a good place to go, considering what they're expecting to happen in the Eurozone.
No question about it. Now, the U.S. has for a long, long time been thought of as the Brinks truck, in other words, the armored car, the place that foreigners could go and they could stash their money in the U.S., in our banking system and in our financial system, and that one I wouldn't trust, but but they could buy assets here and have them outside of their country. And what's really interesting is some people talk about the decline of the U.S. and the rise of China, is that Chinese millionaires are scrambling to put their money in the United States. I mean, folks, this talk of U.S. decline, it is accurate. I agree that the U.S. is going downhill, but my point is, compared to what? I mean, China has a long way to rise before it even comes close to the U.S., in my opinion. We'll see, but our guest, I think it's our next guest, actually, that I'm going to have on here in a couple of minutes, I think we talked about that in that interview. I can't remember, but one of our upcoming guests is going to talk about import-export parity between the U.S. and China, which is quite an interesting discussion. We've got that coming up either on this guest here in a few minutes or on a future show. But Steve, any more thoughts on that?
Well, it's blatantly obvious to the foreigners that this is the time to buy. And they feel they're willing to go through that process of getting their money, especially out of China, for example. That's not easy to do. I've worked with clients on that, and getting a good chunk of money out of China into the U.S. is not an easy project, but they're willing to do it because of how confident they feel in where these assets are priced at right now.
Yeah, no, the deals are nothing short of incredible. They really are. And by the way, foreign nationals listening to the show now, I just want to remind you that we do have special financing available for foreign nationals. So make sure you go to jasonhartman.com. You can contact one of our investment counselors about that through the website, and they will be glad to help you line up financing for foreign nationals. Very unique opportunities there. Hey, two more quick things, Steve, and then we got to run. But I wanted to talk to you about two more articles. One is about student loans. And this one, I've talked about it many times on prior episodes, but this student loan thing, this is the next big bubble in our financial system. And there are over $1 trillion in student loans now. See, this is what happened is the government flooded a certain system, the college system, with money by doing these student loan guarantees. And all that they did is make the price of college skyrocket through the roof. College is largely a ripoff nowadays. I mean, if you compare the regular inflation rate, the broad inflation rate, and the consumer price index to the tuition inflation rate, you'll see that the tuition inflation rate has been about double the standard inflation rate. I mean, that's just mind-boggling. What has gotten so much more expensive about running a college? I think it's gotten a lot cheaper with technology. I mean, all these kids today, I live a block from ASU, Arizona State University. You know what all these kids do? They take their classes online now. They use a program called Blackboard, and they do everything online. I mean, they don't even need to go to a campus anymore. It's unbelievable. I've got a friend of mine. She wants to move to Washington, D.C., and she goes to ASU, and she wants to get into politics. Oh boy. and I said, well, what are you going to do? You going to change schools? She says, no, I'm just going to stay with ASU and take all my classes online and live in Washington, D.C. So think of how easy that makes it for the university, how cheap it makes education to provide it. They have massive scalability of the internet. So I think if they weren't such bloated bureaucracies, the cost of tuition should really be lower than it was decades ago, not higher. But the government flooded the system with money. And so, look, what's the definition of inflation? What happens? Too many dollars chasing a limited supply of goods and services, that causes prices to go up, doesn't it? And that has absolutely happened with college. But what does this particular article say? This is a new twist on it, right?
This is a new twist, and this is going to sound eerily familiar with a very broke government scrambling for dollars wherever it can find it. But if you're a current recipient of Social Security benefits and you owe money in student loans, expect to see part of those Social Security checks levied by the government in order to pay off the student loans.
Unbelievable. So now what they've done, not only are student loans the only debt not dischargeable in bankruptcy, it's the only one, they are now saying that they're going to levy your Social Security payments, okay, when you deserve them years later, they're going to take those. If you haven't paid your student loan, they're going to steal your Social Security. Now, Social Security was supposed to be a totally separate and distinct program, completely on its own. But now the government is finding ways to just cheat people out of that. It's unbelievable. You could have paid into the system your whole life, and they have now found a way to tie the student loan to that. But you know what this all means, Steve? What this means that this Generation Y, the largest demographic cohort in American history, 80 million people, depending on who you talk to, bigger than the baby boomers, these people are going to be renters for a lot longer. Their family formation is starting much later. They're not getting married as young. They're not having kids as young. Many aren't getting married or having kids at all And they're going to be poorer because they're going to be burdened by this massive student debt. And you know what that means? That means a lot of them, unfortunately, are not going to be able to buy a home. So what are they going to be? They're going to be renters. And folks, you people listening are investors. Let them rent that housing from you. Provide a service to these people because God knows they need it. The demographics coming at the rental market now are probably the best they've ever been in the history of the human race. I mean, it is so incredibly powerful. This is to use the words I used of those articles about adjustable rate mortgages, this is a tsunami of renters coming at you. Take advantage of it.
It certainly is. It certainly is. And the government's going to be looking for money wherever it can get it. I'll go on record on the program today, watch next in line on this student loan thing is they're going to start to levy tax refunds in order to cover student loan defaults. And it's just more pressure. Like you say, people have to downgrade. They can't buy the McMansion anymore. They can't do these things. And they have to live in reasonable rental housing. That's their only alternative.
Yep. And everybody listening can provide it to them, so do that. Hey, I want to talk to you about some more articles, but you know what? We don't have time, Steve. This has been a great discussion. Thanks for joining me today.
Anytime, Jason. And I'm doing so great now that the world would owe me a rebate. Do I have it right now?
Well, I agree. I hope everybody thinks so too. So that's awesome. Okay, Steve, thank you so much. We will be right back. Oh, by the way, a couple quick things I just want to announce here. Be sure to join us for our Atlanta Creating Wealth Boot Camp and Property Tour at the end of September. You can sign up at jasonhartman.com/events. And that'll be a great program. We'd love to meet you there in person. And also check the website, the blog, go back and listen to the past episodes of the podcast. And check out our educational products while you're at the website as well. I think you'll really like those. And we will be back with our guest here in just a moment. Be sure to call into the Creating Wealth Show and get your real estate, investing, and economics questions answered by me personally. We'd love to have you call in, share your experiences, ask your questions, and a lot of other people listening have those very same questions. So be a participant in the show at 480-788-7823. That's 480-788-7823, or anywhere in the world via Skype. Jason Hartman, ROI. That's Jason Hartman, ROI, for return on investment. Be sure to call into the show, and we are going to enter all of the callers in a drawing for some nice prizes as well. So be sure to call into the show, and I look forward to talking with you soon. It's my pleasure to welcome Keith Fitz-Gerald to the show. He is the chairman of the Fitz-Gerald Group and chief investment strategist at Money Map Press. He's also the author of a fantastic book entitled Fiscal Hangover, and it's great to have him on the show today. Keith, welcome. How are you?
I'm doing well. Thanks for having me on the show. Appreciate it.
Pleasure is all mine. Where are you located today?
Well, I am physically coming to you from Beaverton, Oregon. Normally, I split my time between here and Japan and the rest of the world. I do travel quite a bit in an effort to see things that other people don't see, and I think that gives us an edge when it comes to finding opportunities, even in today's world.
Mm-hmm. Fantastic. Well, you've got subscribers in 35 countries, and you've got a huge resume, so we're looking forward to hear what you have to say. Maybe the first thing we'll start, since it's so topical, is can we talk about Goldman Sachs and the recent the recent decision by the Justice Department not to do any indictments, which a lot of people are pretty appalled about that. But what are your thoughts on it?
Well, there's two levels on this. Number one, I think it's an absolute travesty that they are dropping the criminal probe of Goldman Sachs. So far, we have not had a single mega bank, nor even a trading house, been held accountable for their role in the financial crisis. And technically, this is where it comes down. Technically, the Justice Department has really said that they can't meet the criminal standards of proof needed to prosecute. That, to me, is a cop-out, and it suggests three things. It suggests, A, a lack of competence in the Justice Department, potentially. B, the fact that we have a clear need to change the laws so that they can prosecute this kind of stuff. And C, perhaps the worst of all things, is that the sleazy characters that are involved in this continue to maintain their incestuous relationships at all levels. And by this, I mean our regulatory authorities, the traders involved, the administrators involved, the folks inside the Beltway who make the decisions. This is just disgusting that selling clients privately, materials privately described as crap is acceptable behavior.
So basically, the allegations stem out of Goldman Sachs unloading incredibly toxic and probably worthless assets onto other firms?
Well, other firms, into the trading networks. These were things that in many cases Goldman Sachs was trading directly against their clients. Facebook is another great example of that.
Yeah.
Goldman Sachs, when it gets involved in a transaction, frequently comes in the very early stages. One part of the firm buys it for its own accounts. The other part of the firm is ostensibly selling it to other clients. So, you're at odds with each other. People who go to Goldman Sachs and think that the firm is acting in their best interest are in for a very nasty, rude awakening.
Well, I'm sure you're familiar with that letter. I read it on the show from a departing high-level exec with Goldman. Talked about how the firm has changed over the years and how it's just become this orgy of greed. That's my own description, but it's unbelievable.
Well, I don't think you're far off. I think that one of the sad things is that banking should be boring. And in today's day and age, the financial crisis has proven that when you have bankers allowed to trade against their clients, when they don't have to disclose their activities, and when in fact they can run the roost, something is dramatically wrong with the capital system that has functioned so well for so long.
Yeah, and that actually leads to a good question. What is wrong with it? I mean, it seems that the attitude, really there was a huge shift in the 80s, I would say. I'm not a Wall Street historian by any means, but it seems like the old mentality used to be invest for income, and then it sort of changed, invest for speculation. It's all about a good story. And all of the firms started acting like there's no tomorrow. Just take what you can get today, rape, rob, and pillage, and let the chips fall where they may. What's with this sort of short-term mentality that's going on?
Well, I think there's a couple things, and I think actually I allude to this in my book, Fiscal Hangover. If you go back and you look at market history into the late 1800s, early 1900s, the stock market was viewed as the domain of professionals. The average individual did not invest in the stock market. That really didn't come into vogue until about the 1920s, when all of a sudden there was easy money available, and there was the perception that somehow the stock market is a guarantee of future returns. Somewhere across the line in the last 50, 60, 70 years, that became a proxy for savings. So really, at the very beginning, there wasn't this idea that you could go and make your wealth in the stock market. That's a relatively recent development in history. As far as what drives this, I think there's a couple things going on. Number one, we had the dramatic increase of leverage. At the end of World War II, we were levered up roughly 10 to 1. So that meant there was $10 in the system for every one that was borrowed or lent. And that gave us a certain amount of flexibility when it came to rebuilding much of the world economy that literally had been torn apart through conflict. In the 60s and 70s, that went up to 31, then it went to 60 to 1. In the Commodities Modernization Act in 2000, by the time that hit and the restrictions were removed on the transparency and reporting requirements specifically associated with off-balance sheet investments like the credit default swaps and things that are driving this financial crisis now, leverage reached almost 100 to 1. So it became a constant battle of not necessarily the return on your money, but the return of your money. And when firms involved changed their compensation plans and quarterly reporting accelerated, you had a tremendous mismatch between three things: the regulatory function, the needs of the investors, and the owners of the firm, all of which were at odds. And that promoted an activity that is not unlike the gunfight at OK Corral. It's the Wild West, last man standing wins. And in this case, it's the firms.
Yeah, it's just unbelievable. It's certainly not just Wall Street. I mean, it's government too. I just can't believe, like, year after year, there's this debate on spending and debt, and it's been going on for decades, time immemorial, really. And our spending's up another $2 trillion plus. I mean, this is just crazy.
It's an abomination. It is irresponsible. It's obscene. It ought to be an embarrassment to anybody that's an elected official. But the sad thing, that $2.1 trillion that we're about to argue about for another, boondoggle here, another bunch of glad-handing politicians, That's a fraction of what's actually the problem. That is 0.96% of the money we already owe ourselves. According to Lawrence Kotlikoff of Boston University, the actual fiscal gap, that's the present value difference between projected spending and income we've already approved, is $222 trillion. That's $11 trillion more than last year.
Unbelievable. I mean, that's the unfunded mandates and entitlements then, right?
That's right. So they're fighting over a rounding error. I mean, they're trying to fix a leaky faucet when there's a financial tsunami sitting out there. It is so unbelievably irresponsible as to defy belief.
Now, Lawrence Kotlikoff was on the show before. What year are you talking about? You know, when you say, because I used to call it 5 years ago, I used to call it the $60 trillion time bomb. And apparently my estimate was just massively low. And, you know, I've had guests on talking about $120 trillion. But what year does that go through? Is that projected out to, say, 2030 or how long?
Yeah, his most recent work, the $202 trillion, is the present value associated with last year's data, and that's according to the Congressional Budget Office.
But I mean, those unfunded mandates and entitlements, in terms of, you know, how far in the future is that projected to?
That varies by the programs involved, as I understand the research. So some of the programs extend 2020, some of them are 25. The very long ones like Medicare and Medicaid may be even as long as 2030. But again, the difference here in the way that he's calculating it versus the way that the guys inside the Beltway are calculating it is that he's saying, look, it's money we've already allocated and appropriated. Therefore, it is not only appropriate but necessary to estimate the present value cost of that. And I think Kotlikoff is onto something, because the present value of money is how the entire world functions. It's kind of like Wimpy in those old Popeye cartoons. You know, you give me whatever dollar for today for a cheeseburger on Tuesday, or however that expression goes.
You know, Keith, I got to say that I love that quote. I use it all the time in my live seminars, and I think I've said it on the show before, because Wimpy understood inflation and how to invest. You know, he said,
yes, he did.
He said, I'll gladly pay you Tuesday for a hamburger today. You know?
Exactly. And so I think Kotlikoff is, you know, people are fighting over this $2.1 trillion, and we're going to have lots of sound bites and very earnest-looking politicians and attack ads and all kinds of other things. But the reality of the situation is we've got 535 ding-dongs inside the Beltway, none of whom understands that they voted this stuff in.
Yeah.
It's not the president, it's not the Bush-era tax cuts, it's not Clinton, it's not any particular administration, it's the collective body of our leadership.
It's just unbelievable. It really is, isn't it? Many people have said you are a great visionary, possibly have the best predictive record in business. I mean, what do you think one should do in light of this, all the Wall Street corruption, the government corruption, and just largesse? You know, I say just get into long-term fixed-rate debt, you know, against commodities. You know, that's kind of my
thinking. This is interesting, because now you're getting into the fun stuff. You know, as devastating as this is going to be in terms of being a financial crisis, one of the things we know from history, beyond any shadow of a doubt, is that every time we have a great inflection point, we have massive wealth creation opportunities. What you have to do now is simply concentrate on protecting your assets in the meantime. So to me, there is tremendous opportunity, for example, in energy. There's tremendous opportunity in medicine. There's tremendous opportunity, believe it or not, even in short-term U.S. Treasury debt. I, for example, don't believe that we've seen the end of the debt bubble. I think that things are going to unwind a little bit further, and that we're going to actually see negative interest rates in this country for a short period of time, much as we did in Japan and as Europe is already experiencing.
Well, let me ask you a question about that. Don't you think we already have them? I mean, you know, if you ask me...
Well, we have them in nominal terms, for sure.
Right,
In
other words, and let's just explain that to the listeners, we're both talking about the same thing here, I hope, which is that you can borrow money for below the rate of real inflation, right? That's negative interest to you, right?
Right.
Okay, good. So we agree. Go ahead.
But I think we're actually going to see the coupons go that way. I think we're going to see, you know, in Japan, for example, where I've been for more than 20 years now, you know, we saw this in the 90s where things became so unsettled that investors had to effectively pay the government to keep their money overnight. Now, in Germany, we're seeing some of those things happen already. We saw that recently with several other countries over there, where the negative rates on overnight lending the rates on overnight lending literally went negative for a couple days or a day or two on auction. I think we'll see that here, and that suggests to me that we're going to see the 10-year note, for example, break 1%. We might even see it go negative before this is done. So point is, yes, this is terrible. Yes, this is a fiscal disaster, but that doesn't mean you have to, A, stick your head in the sand and have somebody kick you in the butt when this is over, and B, there are plenty of defensive things you can do with your money today. Now, I heard many of the same comments back in 2000 when we had the dot-bomb crash. People said there's nothing to buy. Oh, this is terrible. We can't do anything. Well, that's not true, because if you look at something like Altria, for example, which is a big, what I call a global stock, something with large diversified exposure, highly recognized brands, that stock, in fact, returned well over 1,000% in the last 12 years if you look at the total return. So the price and the dividends matter. So those are things you can do. Energy, for example. In times of stress, the world doesn't start using less energy just miraculously. Even if we have perfect fungibility right now with another source, scientists estimate we're looking at 30 years before the 60,000 industrial processes that depend on petroleum are altered or changed or switched. So that suggests to me you need oil, you need energy investments, and many of those things actually pay very high dividends. So even if the market goes to heck in a handbasket, you are accumulating purchasing power, you're hedging your wealth, you're protecting your assets, and this is the best part, you're getting ahead for the recovery, because it will get here eventually.
Most of the inflationists, or the people who think society is going to collapse in general, and some of those get pretty far out if you ask me, but you know, they would say that in your answer, Keith, you left out one huge thing, and you know what it is. It's a 4-letter word, gold.
Yeah.
I just wanted to get your take on the metals. I'm definitely not a gold bug. I mean, I own some of it. I think it's a defensive strategy, not an offensive strategy. I think it's okay. I don't think it's anything great, like some would have you believe. But, you know, what are your thoughts about the metals, gold and silver? You know?
Well, I think you need them. I mean, you know, don't get me wrong. I think gold is a very, very important part of any investor's portfolio today. It has to be. And the question is, do you want to buy gold because it's going to appreciate, or do you want to buy gold because it's not going to appreciate? I think the answer is somewhere in between. If you think the world is going to hell in a handbasket, then I would buy diapers, bullets, and medicine, frankly.
Mm-hmm, yeah.
If you look at, for example...
And maybe some vodka, too.
Yeah, vodka, right, exactly. Because if you look at, for example, Hurricane Katrina, it wiped out an area roughly the size of Great Britain. They weren't trading gold for cheeseburgers, but they were trading bullets, diapers, and medicine in the aftermath. And that says to me, you know, boy, that's something really critical here. On the other hand, I had a gentleman come up to me after I finished the talk in Florida, and he says, you know what? He says, I get it. He said, I didn't understand you a few years ago when you made that comment, but I get it now, because I buried my wealth in a fence post, and it's now 30 miles out in the Gulf of Mexico.
Meaning oil?
His gold.
Oh, his gold. Okay.
He had buried gold coins in a fence post in a coffee can, and it had been wiped out to sea.
Oh,
so he understood the difference. You know, he said, okay, I understand this now. And what that points out is you want to buy gold really not because it's going to go screaming higher. You want to buy it because it's going to hedge the rest of the things in your portfolio. My favorite way to do it is to buy it because it hedges the value of your bonds. Gold has never, ever, despite what you hear on those late-night commercials, never, ever been proven to be an inflation hedge. But it has been proven to be a great crisis hedge. And that's where, you know, you can hedge that against the value of your bonds, which in fact do react to inflation and to interest rates.
Why do you say contrary to, that's interesting, your statement there, contrary to the popular belief, what you hear on late night TV, that gold is an inflation hedge, you say it's not. What do you mean by that? Just elaborate on that if you would.
Sure, you bet. Well, you know, one of the things you see if you watch all those commercials at night is gold's an inflation hedge and you need to buy gold because of inflation. Really, that's not true. It's never statistically been proven to have a valid relationship to inflation or inflationary rates. But it has been proven to have a statistical, roughly a 10-to-1 relationship with interest rates themselves, which are symptomatic of inflationary pressure. Therefore, the more appropriate use of gold is not the bet that it's going to go far higher, but the bet that it's going to hedge the value of your bonds and therefore the income stream that those things kick off.
It's just interesting, and I want to get off this gold topic, but I got to mention one more point because I have some other stuff I want to cover with you, of course. But you ask any gold bug, and they talk about the performance of gold over the past 10 years, which has been good, finally.
It's been extraordinary, yeah.
But you know, we've waited a long time. I mean, you go a couple decades before, and it was lousy. I mean,
well, and again, this points to, you know, if the term gold bug has some very negative connotations in my mind. One of which is that they invest in gold at the expense of a balanced and disciplined investment program with the rest of their assets. And if that is your definition of the gold bug, for example, I would submit that's a bad idea, because essentially what you've got to have is a Pyrrhic victory. You've got to have everything else go to hell in a handbasket in order to make out like a bandit on gold. On the other hand, if you're using it as sort of a 5 or 10% allocation in your portfolio, you're hedging the value of your bonds, you're using it to preserve value and wealth, as many central banks around the world are doing, I would submit that that's a more appropriate use of the gold.
Yeah, and I would agree. And so what I was going to say is, if you ask any gold fan, maybe I won't use the word gold bug, I'll just say a fan of gold, you ask any of them, did the gold go up in value or did the dollar go down in value? And they will universally say the dollar went down. Well, then what did you really gain? All you did is you treaded water. That's great. It's better than losing money, but it's not an offensive strategy, and that's really my complaint about it. So,
well, and there's one other thing that they need to consider at the moment, and I talk to thousands of investors a year around the world about this, is that now, for the first time in history, we have the ability to collateralize trades with gold. And what that means is that if the stock market gets into trouble, then very often the institutions, the very first thing they're going to let go of is gold, because it's highly liquid and they can perfect the counterparty risk. So gold, in fact, if stuff does go down, gold, in fact, may be one of the very first things that gets sold instead of marching higher.
Well, that's a very good point. There will be an unloading of gold, which will actually suppress prices, initially at least. So,
that's right.
Yeah, very good point. And I think the same rules apply to silver pretty much, right?
Yes, and and silver is an industrial metal, obviously, so there's a lot of use for it, but I think roughly speaking the same rules apply, although silver does not have the relationship that we've been able to quantify with bonds and interest rates.
Let me take a brief pause. We'll be back in just a minute.
I've never really thought of Jason as subversive, but I just found out that's what Wall Street considers him to be.
Really? Now, how is that possible at all?
Simple. Wall Street believes that real estate investors are dangerous to their schemes because the dirty truth about income property is that it actually works in real life.
I know. I mean, how many people do you know, not including insiders, who created wealth with stocks, bonds, and mutual funds? Those options are for people who only want to pretend they're getting ahead.
Stocks and other non-direct traded assets are a losing game for most people. The typical scenario is you make a little, you lose a little, and spin your wheels for decades.
That's because the corporate crooks running the stock and bond investing game will always see to it that they win. This means, unless you're one of them, you will not win.
And unluckily for Wall Street, Jason has a unique ability to make the everyday person understand investing the way it should be. He shows them a world where anything less than a 26% annual return is disappointing.
Yep, and that's why Jason offers a one-book set on creating wealth that comes with 20 digital download audios. He shows us how we can be excited about these scary times and exploit the incredible opportunities this present economy has afforded us.
We can pick local markets untouched by the economic downturn, exploit packaged commodities investing, and achieve exceptional returns safely and securely.
I like how he teaches you how to protect the equity in your home before it disappears and how to outsource your debt obligations to the government.
And this set of advanced strategies for wealth creation is being offered for only $197.
To get your Creating Wealth Encyclopedia Book 1, complete with over 20 hours of audio, go to jasonhartman.com/store.
If you want to be able to sit back and collect checks every month, just like a banker, Jason's Creating Wealth Encyclopedia series is for you.
Let's kind of switch gears here. Recently, you talked about China missing its export estimates. What's behind that? I mean, is that just a sign of things cooling off?
Well, a lot of people are interpreting it that way, and they're saying, oh my gosh, the sky is falling. Well, they've been saying that effectively for 40 years, and for 40 years they've been wrong. Now, one of these days they're going to get it right, but so far they haven't, and I think that's very painful because those who have sat out China have certainly missed a tremendous run-up in an expansion of wealth. But the thing that people are missing is this, is they're saying, China missed its exports And that's a big deal because it was only 1% versus the 8% expected. Really what they're missing is that imports actually are up. China has got a stated goal, stated policy goal. This is official government policy that they want balanced imports and exports. People think China lives and dies by its exports, but exports really account for only 2% of the labor force and probably 30% of its GDP. So that's not a country that's going to live and die by its exports. What they should be concentrating on is the imports. They 10 years ago imported 90 cents on the dollar, then it was 95, now it's 97 cents on the dollar roughly. They will, by 2015, be importing just as much as they're exporting. That's going to naturally create surpluses like this in the meantime.
In just 3 years, they're going to have a balanced trade?
Import-export. That's right.
That's unbelievable. I mean,
well, again,
really?
This is what, I have been speaking till I'm blue in the face about this for 20 years. And I'm not, I don't profess to know everything, so don't get me wrong. But here's the thing. People talk continually about China being an export-based economy. It is not an export-based economy. Very small percentage of what it produces is actually exported. The huge growth in China is due to 1.3 billion people who want what we have and who simply want to have a better life and who are developing their own economy at a speed that is 5 times ours, with a huge velocity of money flow that is much faster than ours, and they're doing what's never been done in recorded history, raising the standard of living in an entire country at a speed that we simply can't imagine. So we make the mistake of applying Western analytics to a market that is clearly not Western, and we don't like the results.
Well, Keith, that really begs a whole nother area of thinking here, and that is if China really creates their own consumer class, I know they've been trying to do that, I know they want to do it, of course, that makes sense, then they can sell their great manufacturing power, can sell inside their own country if their consumers have the money to buy. But that leads to a huge potential crisis, frankly, because the way I see it is that they have been kind of beholden to the U.S. to buy our treasuries, and they won't have to do that anymore. And when there's already been a lot of balking about that, and a lot of resistance. But when they don't have to do that anymore, and we can't sell our toxic debt like Goldman Sachs was selling their toxic assets, everybody knows we can never actually repay. Then that portends maybe some pretty significant inflation, because all we can do then, the last resort, is just print our way out, right?
Well, don't read too much into that. And here's how I would push back on that and offer maybe 2 other things to think about. Number one is that this is kind of like a high school dance. We have arrived at the uncertain place where we need China. China has arrived at the uncertain place where they need us. They can no more stop buying our treasuries than we can stop selling them. The 2 nations need each other because our currency, in fact, gives them the flexibility to produce their growth in many ways, shapes, and forms. So they need that surplus, they need that value, and the exports have to continue. That having been said, they are developing at such a speed, with such a ferocity, and they have so much pent-up demand that they have arrived in a space, or they have developed the capacity where we are dangerously close to becoming irrelevant in their growth model. Now, Washington doesn't understand this, and Washington continues to browbeat China and say, you've got to do this and you've got to do that. China has never got to do anything. They've had the world's largest GDP for 18 out of the last 20 centuries. They will have it again very soon. And I think smart U.S. companies, and these are the kinds of companies that I encourage people to invest in, smart companies are already figuring this out. They understand that they've got to localize and they've got to go where the Chinese money is if they want the growth. If they just want status quo, they can go to Europe. They can go to the nanny states of the East. But if they want the growth, they got to go to Asia.
There are some very significant changes. How do you predict that it will be balanced in 3 years? That's just can it really happen?
Well, it's not me.
Fast?
It's actually the Chinese government. They said this in 2010. They reiterated the goal in 2012.
Does it look like it's really possible?
Absolutely.
Wow.
There's no question in my mind that they will achieve it. And having spent, more than half my career in Asia at this point in time, one of the things I have learned about the Chinese, and the Chinese government in particular, is they never say anything that they can't produce. This is already baked in the cake by the time it's been made public. And you can allege, as many people do, I run into this argument constantly around the world, is, well, the Chinese cook their numbers. It's like, well, really? Madoff doesn't ring any bells. MF Global doesn't ring any bells. United States government doesn't ring any bells.
The U.S. government cooks the books, too, all the time.
Every government cooks the books.
Of course they do.
The difference is they've got $3.3 trillion in cash sitting over there as a surplus to pay for all this. They can recapitalize their banking system 3 times over and still have change. We are trying to print our way out of a hole that is so deep we can't possibly see the bottom. Those are very different scenarios, and I think this is not to say China is perfect. There are clearly massive problems over there. They will have their ups and downs. But if you look to our own history, again, as I did in Fiscal Hangover, there are tremendous parallels. They are where we were in the early 1900s, late 1800s. And Beijing is much like St. Louis in the 1850s. It's the jumping off point for a better economy. It's the Wild West. It's a chance to expand. People forget that here in this country, we endured 2 world wars, presidential assassination, multiple depression, recession environments. Over the last 100 years, the Dow was still up thousands of percent. This is simply their century.
Right, but the Dow being up thousands of percent, that's in nominal dollars, certainly more than real. Some of it may be real dollars, but you can also argue since the Federal Reserve came along in 1913, the dollar's lost 96% of its value or so.
Well, that's a very fair point, which is why I continually refer to the need for total return as your investment benchmark. Forget what the S&P is actually doing. Look at the total return, the dividends plus reinvestment. What has that gotten for you? And the answer is, pretty darn decent return over that time period.
Peter Schiff made an interesting statement on CNBC a couple of years ago when he compared gold to the Dow and gold to the S&P, and he said, since the Great Depression, the only stock market returns have been dividends. That's it. The rest is just an illusion created by inflation. I'm almost exactly quoting him. And I have my differences with Peter Schiff, believe me. I've had him on the show. He's kind of the master of the soundbite. He's got some pretty biting
I've been on
soundboard.
TV with him many times.
Yeah. But, I think he seems to be right about that one. Has there been any real gain in stocks other than dividends? And if you don't have dividend-paying stocks, then, have you just treaded water like the gold bugs?
Yeah, that's pretty much, you're treading water, and that speaks to a lot of research we've done over the years. My research shows that on average, dividends contribute to somewhere between the neighborhood of 85 and 95% of total stock market returns. Why on earth, and this is work that's backed up by Robert Shiller, this is Dr. Jeremy Siegel, they all show similar findings. There is a hugely disproportionate emphasis on dividends because they actually produce the returns and the value. So I look back at hundreds of years of market history and I wonder why on earth people would invest in growth stocks when that's the case. And the answer is that Wall Street, in its own self-interest, has created this, for lack of better terms, this huge marketing lie and foisted it upon the investing public that you've got to be exciting and you've got to have all these growth stocks. The data just doesn't bear that out.
Yep, I couldn't agree with you more. It's people looking to hit that sexy home run. I'd say if you can hit singles and doubles consistently, you're going to win the game.
Well, there's a reason why sports coaches know that that's the philosophy. They've got to have consistent runs batted in. They've got to have consistent field goals. They've got to have consistent scoring. The home runs are nice and they're fun and they pack the stadiums, bring the fans to their feet. But you know what? The heavy-duty hitters hit their fair share every single game.
Right. Yeah, no question about it. You had talked recently about how the federal government told the banks prepare for collapse and don't expect any federal aid, no bailouts. What did they mean by that? Do they know something we don't?
Well, that's statement. An interesting question. It's one of these things that people don't think about. They say, oh my goodness, the government told them to do this. Well, that's a logical reaction. Now, from a financial perspective, financial professional's perspective, every financial institution is responsible for preparing contingency plans, and those have always been there. The contingency plans have gotten more detailed and more aggressive since the events of 9/11 and since the financial crisis. But what's different in this particular directive from the federal government is that this is sort of like a living will. The federal government, for the first time, said, hey, you guys have to prepare and detail the actions you would take so that you could liquidate your businesses and not blow up the financial system while you do it. This is an idea that is outlined in, the Dodd-Frank Act, which I think is more like Dodd-Frankenstein. But the bottom line is it's an attempt by the regulators and the congressional body to get our businesses to act decisively if we have another financial crisis. Now, I think it's a great step, but the problem is this is more like a financial Maginot Line and probably about as effective. The next crisis is going to be different than the one we're living through now. And until they break the big banks up and put in some regulation that forces them to choose between commercial banking activity and investment banking activity, we're still at risk. And it doesn't matter what kind of things they put in, but that's where that comes from.
What do you think of Bill Gross's recent comment about how equities are dead? I mean, obviously that's a self-interested comment on his part, I would say.
So.
But what do you think about that?
Well, Bill Gross is a fascinating individual. He makes some well-publicized calls, unfortunately, several of which have been massively wrong and very costly for his investors. For example, in February 2009, he said, get out of bonds. Those are terrible. They're going to go away. That cost an estimated $5.7 trillion, according to Peter Cohen. February 2012, he said the same thing. Again, a mistake. He's back in bonds. So for him to say the death of equities, I can't tell what's going on there, but, certainly his credibility as a bond manager with $1.4 trillion under management, I disagree. I think avoiding equities is a path to ruin. Equities have always involved risk, and risk produces returns. It's how you control the risk that matters when it comes to profits. And most people have that backwards. The other thing to think about, and I think that Gross is missing or simply didn't have time to get into his comments, is that the markets don't price on growth. They price on risk. Pricing on growth is something Wall Street analysts have cooked up to keep you distracted. And so you, again, want to turn conventional thinking on its ear, price for the consistency of returns and the consistency of your profits, not necessarily the growth prospect.
Can you just elaborate on that a little bit more? You said markets don't price on growth, they price on risk?
Right. And if you think about this, so let's use the bonds for an example, because that's something near and dear to Gross's world. If you look at bonds...
That is Gross's world. That's his whole world.
Yeah, that's his entire world,
Right.
$1.4 trillion worth of his
Right.
world. But here's the thing, is people say, oh, okay, I can get 3%, 2%, 1% on my bonds. That's the return on my bonds. Well, a professional trader looks at that and says, no, that's the risk associated with your money. And so the higher the return, the investor's thinking, boy, I can get more from my money. The trader looks at that and says, how much additional do I have to risk to get my money back? The markets price on risk. They don't price on growth. Nobody looks at a stock and says, well, gee, I think it's going to go up X, Y, and Z, except for analysts who perpetually get things wrong. The old joke is God invented analysts to make weather forecasters look good. The problem is that really, if you get down to it, this concept of total return and dividends that we talked about, that's a function of risk. If you control the risk, you'll get the returns, and that's where dividends come from.
Interesting. So I can't imagine bonds would be anything of interest in my view of the world. And, my view of the world is inflationary. Yours may differ, but bonds just get slaughtered.
No, I share that belief. I share that belief. But here's the thing, right, is if you avoid bonds, and if you've gotten out of them like Bill Gross suggested or others have suggested over the years on the assumption that bonds have bubbled out, you've missed one of the greatest bond rallies in recorded history. Now, I think we are dangerously close to the end of that game. I think that interest rates are going to rise and we are going to see inflation change here in the very near term. But before we get there, I think that the crisis in Europe has to unwind. That, to me, says that there's still the need for additional security, and the logical place, the best-looking horse in the glue factory is still the United States dollar and the United States Treasuries. That says to me that there's still appreciation left in the bonds, particularly on the short end of the spectrum. I wouldn't touch 30-year bonds for all the money in China. I wouldn't touch those kind of things now. I wouldn't touch them in the future because those are going to be very volatile. But studies show that if you keep your duration under sort of 4 or 5 years, keep that short-term ladder, you continually roll it over, you can avoid 70, 80, 90% of the volatility of the long bonds and still achieve very similar returns.
Yeah, I don't know. I that seems too risky for me, but that's why there are people who are specialists at doing that and trading and so forth. I just like my simple thing of own lots of income properties and have lots of debt against them.
Exactly. Well, there you go. Because, again, this is the greatest principle in the book. If you can use OPM or other people's money, then, if you can produce income with that broadens and improves your return on equity, and I would argue that that's a good thing to do.
And I just cannot wait for the debt to be decimated by inflation. See, the way I look at it is it's like, we were talking about gold earlier, or really any commodity. The commodity will tread water against inflation. Okay, it'll keep up. It'll just be maybe a nominal appreciation and no real appreciation. Maybe a little bit, but not much. Exceed inflation by a couple points, and that's great if it does. But at the same time, you've got dividends being spun off by the income of, in this example, a property. And then the best thing of all is what I call, and I coined this phrase, inflation-induced debt destruction. Say that 10 times fast.
Oh my goodness, that's like unique New York. I don't think I can say that 5 times real fast.
Hey, I said 10 times. but
I can't even do it 10.
Yeah, there you go. But then inflation will just come along and pay those debts off for you. I mean, if you ask me, that's the U.S. government's strategy with China and Japan.
Well, I think you're onto something there, and I think you're very accurate in your comments. I think that it very clearly is their goal, is they want to have this inflationary piece actually pay off their debts. Now, I think they're also delusional because unlike real estate, if you buy the right property, you have a lot of variables going for you. Perhaps you get a solid income stream, maybe you've got some water nearby, you've got a key retail center, you've got something that makes that uniquely appealing that's going to produce, hopefully, a higher, more stable income stream over time that can be reinvested and turned into other properties or, other investments. The federal government has got a pile of hundreds of billions, of trillions of dollars of schlock on its system, and they are operating on the assumption they're going to be able to spin that off and sell it. Well, I don't know if anybody inside the Beltway stopped to figure out that if this crap is so bad that nobody wants to buy it, what on earth makes them think they're going to write it off on the taxpayer's dollar and then somebody miraculously is going to want to buy it years from now? That just demonstrates to me they don't understand how real money actually functions.
Yeah, I don't know if they understand or not, but I think even if they do, for some of the 500 plus people inside the Beltway do understand. Some don't, but I think by and large they just think, who cares? My time is now, and I'm going to keep buying votes with other people's money, with fiat money, and that's the problem with incumbency. That's the problem with any incumbent politician. Whether it be Obama or anybody else. They just make more promises and create the money out of thin air to keep them.
Well, it's not only that; it's incredibly disrespectful and a disservice to the taxpayers that they supposedly lead or support or whatever the word is you want to use. I think it's incredibly arrogant of these folks to be doing exactly what they're doing.
You know what's amazing, Keith? I just want to get your thoughts on this final thing, and I'll let you go. It's amazing when you look at the left of the political aisle, you look at the liberal side, they somehow have the trademark of the compassionate side. We care about other people. We want to give them free health care. We want to have more welfare, expand the welfare state. All of the stuff that, of course, has been proven over and over not to work. But, we won't even debate that. And I have no idea, by the way, what your political leanings are as I'm bringing this up.
Oh, they're irrelevant when it comes to money, but that's okay.
Okay, you're agnostic in that sense. But what's amazing is I just have to say, how compassionate can it possibly be to spend the money of future generations and saddle them with massive amounts of debt? I mean, where is the compassion in that? To me, I would just call it selfish. Get what I want today, buy votes today.
It's appalling. I mean, there's no other word in the language I think that can be used to describe what they're doing. Other than a bunch of 4-letter ones that are probably not appropriate for a family radio show.
There you go.
So really, these guys are just, it's absolutely criminal what they're doing, and a whole lot of them ought to be summarily removed from office.
No, I couldn't agree with you more. Well, Keith Fitz-Gerald, thank you so much for joining us today. Great discussion with you. Your book is Fiscal Hangover, and you've got some other books coming out. Of course, that's available on Amazon with great reviews, by the way. And your website, that's Keith Fitz-Gerald, and there's a dash between the Fitz and the Gerald.com, right?
There is a hyphen. It's KeithFitz-Gerald.com. But you know what? The better place to go is actually go to moneymorning.com.
Fantastic.
And they will find myself and all of my cohorts and join, I hope, a highly irreverent, fun-filled family of investors around the planet.
Fantastic. Well, Keith Fitz-Gerald, thank you so much for joining us today. Great discussion.
Thank you for having me, and it was a real honor. Appreciate it.
This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.